and they got nothing. They've literally got no gold in there at all. They don't know how they're going to get it. I mean, really. And there's another problem, and that is that how do you invest in gold? Well, your compliance officer won't give you hell if you buy an ETF, but an ETF is actually quite an expensive way to do it. What you should do is buy physical metal and store it properly, and it'll cost you, basis points, no more than that. But the problem there is that gold and silver are not regulated investments. So you've got a lot of explaining to do to your compliance officer. But that's the best thing to do. I'd sort of calculate, if you look at the actual level of exposure at the moment, portfolio exposure to gold around the world, and we're talking about an estimated 300 trillion of portfolios total around the world.
They've got no gold left, and this time it's not a rumor. According to Alasdair Macleod, the Western financial system's vaults, once thought to hold the backbone of global trust, are now virtually empty. The gold's been leased, released, and rehypothecated into oblivion, and the paper game that kept the dollar alive is beginning to crack. But that's not all. Silver's showing the same signs of stress. Macleod says the world's heading toward a physical metal shortage unlike anything we've ever seen. So today, we break down his urgent warning, what's really happening behind the vault doors, and why this moment could redefine wealth as we know it.
Their exposure is about 0.5%. If you're going to increase it by only 1%, at current prices, that's 25,000 tons. Where are you going to come from? It's just not there. So I think we're in a situation which, we've already beginning to see a squeeze in the market. And this is something Andy's probably a lot closer to than me. But I mean, when I saw all that stuff going out of the Bank of England back in April, the trucks backing up and being told, come back at the end of the month, I started thinking, that's basically leased gold, which before then was just remaining in the vault. Okay, it was a book transfer. So the Bank of Finland would own, say, they would lease, say, 50 tons, and it would be leased to XYZ. It was a book transfer because it would remain in the vaults. Now it's disappearing. Now, if I was a central bank, and I don't think I'm stretching my imagination too far, I would think, hold on, I don't think I want to get involved in this leasing game anymore. I think I'm going to stop leasing because it's now getting more important that we actually have possession of our gold, or at least have it stored without any encumbrances such as out on loan to someone else, leased to someone else or whatever. So I think that's drying up the whole of the mechanism, if you like, in London. So what I'm saying is that, it's all very well turning around and saying, put 20% of your portfolio in gold. It's not there. And worse than that, the liquidity actually is drying up. Liquidity that's keeping the paper market going, because this leased gold, it gets hypothecated, rehypothecated, rehypothecated. It just goes round and round and round, and it's like spinning plates. You used to have those chaps on the stage with spinning plates on the end of, and you'd go around and get dozens of these things spinning, and see them starting to fall to get round and sort of get them going. That basically is the gold leasing game. And a lot of this gold has actually gone. It's disappeared. I mean, the leasing game has been going for so long. Analysts back in the last century were looking at it and saying, where's it gone? And they were assuming that after a lot of diligent research, I should add, that up to, a third to a half of all central bank gold by 2002 was out on lease. And the way Frank Venerosa put it was probably adorning the necks of women. I actually think China bought it, but who cares who bought it? It's not there. I mean, that's the key thing. So we actually do have this additional problem. I mean, the idea that you're going to have time to, sort of cogitate and wait to see developments and all the rest of it. I mean, you could end up missing the boat hugely on the gold game. And of course, the thing about silver is that it's always been the poor man's monetary metal, as it were. And, if they think they've missed the gold boat, they'll go and buy silver. So, and again, there's not a lot of liquidity there. I mean, I'm seeing that in China, stocks have dropped to well under 1,000 tons in the SHFE. This squeeze is evident again. And I see that this morning, there's a small backwardation between spot in London and COMEX. So that's returned after one day. I think it's 1 day of normalizing. So the situation, I think, when it comes to, the availability of metal is not there to accommodate investment strategies turning around and saying, well, you should up your gold content. And I think what it means is that you should actually buy it sooner rather than later, sooner before all the other guys. First of all, when Bretton Woods ended, there was a big propaganda effort by the US Treasury to persuade everybody that gold was no longer part of the monetary system. Now, I think it's important to know that that actually goes against common law. Common law is that gold is final settlement and everything else is credit. And this goes back to the first set of laws produced in Rome, which were at 448 BC. That was refined by jurors in the following decades, following centuries, and then incorporated in Justinian's Pandex. And of course, out of the Roman Empire came all the countries, the European countries, from the Urals, or if you like, from Russia all the way through to Portugal, who went out and colonized the world, including the great US of A. So everyone's common laws outside China and so on and so forth, which is somewhat different, everyone's common laws had the same thing. And that is that physical metal, gold, silver, was final settlement and everything else was credit, including fiat currencies. That's the important point. They are credit. And the value of a fiat currency depends on two things. Firstly, the quantity of its issue, and secondly, the faith that its users have in the value of that currency. And the problem is that fiat currencies always come to an end. And we've had this regime now, based on propaganda, no more, for 54 years. It's coming to an end, in my view. Why is it coming to an end? It's coming to an end because governments use fiat currencies always as a means of accumulating debt without having to, if you like, keep the value of that currency tied to gold, which limits, it cramps their style. It really does cramp a government style. So you always find that these fiat currencies end in a massive mountain of debt. That then collapses in terms of its value or counterparty or bankruptcies or whatever.
Alasdair Macleod starts with a revelation that's shaking the precious metals world. They've literally got no gold in there at all. He's referring to the gold once stored in the Bank of England's vaults. Metal that's now quietly disappearing as central banks and bullion dealers scramble to cover paper claims. For years, this leasing system worked through book entries. No physical movement, just digital promises. But now, the physical bars are actually leaving the vaults, and the illusion of endless supply is breaking down. He explains that most investors today are trapped in paper products, gold, ETFs, futures, and synthetic positions that don't guarantee real ownership. The compliance-friendly option isn't necessarily the safe one. Macleod argues that real wealth protection only comes from owning physical metal, securely stored and outside the banking system. The problem, he warns, is that there's not enough of it left. Out of roughly $300 trillion in global portfolios, only 0.5% is currently allocated to gold. If investors were to raise that exposure by even 1%, it would create a 25,000-ton shortfall, a number that simply can't be met with current mine production or reserves. That's why, he says, when the shift toward real assets begins, gold and silver prices won't just rise, they'll reset. Meanwhile, the leasing market, the heartbeat of London's paper gold system, is dying. Central banks are pulling back, realizing that the game of paper gold has gone too far. As this liquidity dries up, the same ounce of gold that's been pledged 20 times over can no longer satisfy demand. It's the equivalent of musical chairs in the vault, and when the music stops, someone's left holding a promise instead of a bar. Macleod connects this to history. Under common law, gold and silver are final settlement. Everything else is credit. Fiat money, bonds, and even digital currencies are just forms of deferred payment that depend on trust. Since the end of Bretton Woods in 1971, that trust has been stretched beyond breaking. Governments have used fiat currencies to fund endless deficits, building what Macleod calls the largest credit bubble in human history. Now that bubble is starting to burst. He warns that when this happens, everything tied to credit, stocks, bonds, even Bitcoin, will sell off in a rush for liquidity. Foreign investors hold over $16 trillion in U.S. stocks. Once confidence falters, that money will flee. The only asset left standing will be the one not based on anyone's promise: physical gold and silver. He adds that silver, long called the poor man's gold, is facing its own crisis. Chinese silver reserves are reportedly down to less than 1,000 tons, and industrial demand continues to surge. When gold becomes scarce, investors will turn to silver, and its price will explode even faster. In short, Macleod's message to investors is crystal clear. Buy physical metal now, before the crowd wakes up. The next phase won't be about profit. It'll be about survival.
And so, are we close to that point? I think we're getting pretty close to it, is my view. And when it happens, everything changes. Absolutely everything changes. And I think, I'm very glad I don't actually manage money anymore, but it seems to me that this is going to be very, very difficult for investment managers to handle. And this is why I say, I've tried to sort of say earlier on, and I know people have joined since we started this, that the first thing to observe is the bursting of the credit bubble, which has been funded basically by the expansion of bank credit. That's where bank credit has been going. That's why the S&P has risen by, 50, 60, 70% or whatever in the last 2-3 years. That's the first thing. Now, when it pops, when it bursts, then you will find that everything which people own in portfolios will be sold down, particularly where they've got profits, because they will, it's human nature. When it comes to the losses, you just ride them. But what you do is you liquidate the things that have been performing well, that you got good money on. So I think even gold mines would be sold out. But the one thing they haven't got is physical metal. They don't own physical ETFs, etc. And I think that when the bubble pops, you may have to count up to 10 or something before it happens. But the next phase will be bond yields rising, making the situation worse, foreclosures in the market. You'll find foreigners will be selling what to them are foreign stocks, and bear in mind they've got 16 trillion invested in US stocks. The whole thing is going to be a mess, a huge, great mess. And trying to manage your way through that, I think is going to be very, very challenging. And my strategy, I think, would be, get gold now, because there is absolutely no doubt it won't be available at anything like these prices once these things happen. And silver, incidentally. Well, I know it's not a monetary metal, but, if you look at a gold-silver ratio of, 83, 84, this is plainly ridiculous. It should be 30 or lower. So the two monetary metals, I think you take a position in those, and then you've got to play the end of the bubble. And that basically means lightening up on rising prices from here, on tech stocks in particular. Bitcoin, incidentally, correlates beautifully with the Magnificent Seven. So if you've got that as well, I would get out of that. And when it comes to bonds, you don't want to be invested in duration. I know that insurance companies and pension funds look at matching, if you like, duration with their liabilities, of course. But as much as possible, you want to go short on duration. I think that's desperately important. And then what will happen, I think, at the end is that your position in gold will actually rescue all the other positions. And that's where you've got to get to. You don't have to have a huge amount of gold to get that. You don't need 20%. But get in there because, as I said earlier, if you look at a 1% increase in gold in global portfolios, that equates to a demand at current prices of 25,000 tons, and it is not there. It's quite simple. So, if you leave this one, you're going to miss the boat. Yeah, it is interesting that the first time, certainly during this fiat currency life, which is now 54 years and counting, we actually have major investment managers, or rather, I suppose, investment strategists turning around and saying you ought to actually allocate, 5, 10, 15, 20% of your portfolios to gold. The thing that's interesting is that these big banks, they've got massive amounts of funds under management. And, we're talking about the sort of net worth individual portfolios. The sort of thing I understand people like Goldman's have got about $1.25 trillion under management, Bank of America another trillion, trillion here, trillion there, and all the rest of it.
Macleod's warning isn't just about markets. It's about the end of a monetary era. The fiat system that's ruled for 54 years is reaching its breaking point, and the truth behind the vault doors is finally surfacing. When confidence in paper dies, only real assets remain. So here's the question. If the gold's truly gone and the vaults are empty, what happens when millions of investors demand delivery at the same time? Drop your thoughts below. Will gold and silver finally be repriced overnight, or will the system rewrite the rules again? If you found this breakdown helpful, smash that like button, subscribe to MacroEdge, and turn on notifications, because in the weeks ahead, we're tracking every move in gold, silver, and the collapsing paper system.